The May monthly inflation indicator showed that headline inflation fell to 5.6% over the year to May. This followed a 6.8% outcome in April and was lower than expected by economists. This is certainly a positive sign and provides more evidence that the disinflationary process is underway. However, the details get a little murkier when we look under the surface. The significant drop was largely driven by a meaningful fall in fuel prices. These were impacted by changes in the fuel excise rate last year and have been volatile in recent months. Holiday travel and accommodation was another category recording significant price falls in the month. Prices in this category can also be quite volatile on a month-to-month basis. When we strip away some of this volatility, the picture is less encouraging. Prices excluding volatile items and holiday travel barely budged. This suggests that underlying inflationary pressures are remaining more persistent than first meets the eye, as has been the case overseas. The Reserve Bank would certainly have taken note. Another area the RBA is looking at closely is consumer spending. Here, we also received an update which showed surprising resilience. Retail spending rose in May, with spending on cafes, restaurants and takeaway food remaining robust. This suggests that spending on services may be holding up, which will likely be a concern for the RBA. Added to this picture is a labour market that remains strong. Almost 76,000 jobs were added in May, and the unemployment rate remained around its lowest level in almost 50 years. Some gradual slowing is emerging as the demand for labour comes into better balance with supply. For example, job vacancies data showed that vacancies continue to move lower, but they are coming from very elevated levels, and the process is expected to take some time. What does this all mean for the RBA's meeting next Tuesday? This week's data shows that underlying inflationary pressures may be remaining sticky. Consumer spending surprised to the upside, and the slowing in the labour market is taking time to play out. These factors suggest that more tightening may be required. On the other hand, the cash rate has already moved a long way, and a material slowing in the economy is underway. On balance, we think that the scales are tilted towards another hike. But one thing is for sure, it will be another finely balanced decision.